Welcome back in. So today we're going to talk about a few companies that are actually underperforming and that we got wrong. There's many companies I've gotten right on this channel, and I'm never going to hide from the fact that sometimes I'm going to be wrong here. And the reason why I'm wrong is nothing that I did wrong. It's actually management's execution or just not being told the whole truth. And so there's a couple companies I really want to talk about. Number one is going to be Medical Property Trust. Now, this is a reliable dividend stock for most dividend investors. And as we've stated on the channel, dividends are a nice bonus, but you can't just buy stocks because they pay dividends. There's a lot of things that we have to look at from a financial perspective to make sure that this dividend can be intact through the good times and the bad. And right now, it is definitely bad times for a company like Medical Property Trust. The second company I want to touch on is actually going to be PFIZER. This was one of my most bullish positions going into 2024, and I'm really disappointed on what management has done. And I'm going to tell you where I stand with PFIZER as well. Now, some companies that I brought up recently have actually been outperforming as well. Now, Medical Property Trust was recently over a $24 stock. It is now trading at $4.70. Down 68% over the last 5 years, down over 80% from the recent highs. Now, if you're not familiar with Medical Property Trust, this is the second largest non-governmental owner of hospitals in the world. We can see that they are fairly well diversified throughout the globe, with the majority of their holdings being held in the United States. We're going to go through their recently quarterly report. I'm going to give you my opinion on exactly what's going on, and there could be a tremendous amount of upside if executed well, and if things go right for Medical Property Trust. But there's definitely some problems here, and we're going to go over why it's fallen from $24 a share down to $4 a share. Let's start out with the most interesting fact here, that there's $19 billion worth of assets within this company, and this company is sitting under a $3 billion market cap. So obviously it's getting priced in for some bad stuff here. But we can see here that there is a tremendous amount of underlying assets for a $3 billion market cap. And so when it comes to owning REITs, it's about the operators or the people that are running the properties that the company actually owns. And one of their biggest tenants or operators is going to be Stewart. Now, there were rumors going around that Stewart was a bad tenant and things were going to happen. And we slowly saw the stock price bleed from $20 down to $15 and $13 a share. And that's actually where I became interested, because I thought sometimes these rumors could be buying opportunities. And I didn't think that Stewart would be that impactful to their overall business, and that's when I really started covering the stock. Stewart operates roughly $3.6 billion of Medical Property Trust properties, which makes up 19% of their portfolio, which is a huge percentage here. And then when we go down the list, we can kind of see how it is diversified with other operators here, going down from 11, 7, and 5. You rather see those lower single digit type numbers and know that they're well diversified throughout their tenants. And so now here comes the absolute atomic bomb for the company. When we look at operators at the top here, it is ordered by the revenue that the company collected, and we can see that at the bottom is Stewart, that they operate the most amount of Medical Property Trust properties, but they are paying the least. And you know that this is going to get ugly if you know that this is the story that's unfolding. And so when we look at how much revenue they collected from Stewart properties, it is negative, while in 2022 they collected $106 million, making up 26.5% of their overall collected revenue. And this is a quarterly collection of revenue, going from $106 million of revenue to $301,000 of losses. So huge problem here, because Stewart is really the one operator that is forcing this company to be negative. So when we bring it down to a net income basis for Medical Property Trust, they lost $9.4 million in the last 6 months versus a gain of $822 million. And we can see here that the story that's unfolding is making sense, that the stock has fallen off from $24 a share down to $4 a share. Now, cash and cash equivalents is sitting at $324 million. And so the question becomes, if their burn rate is going to be right around $40 to $50 million a quarter, you do have 1 or 2 years to kind of sort some things out here and get on a path of profitability once again. And this is where it's really tough, because to me, it doesn't seem like it's really Medical Property Trust that did anything wrong here. I think it was more of the fact that they made too large of their portfolio a portion of made up of Stewart as an operator, and Stewart is obviously not operating the properties well. But this is not also the headache that they have. They also have to look at refinancing costs, and we're going to take a look at their refinancing coming up. So in 2023, They have $508 million of refinancing due here. As far as I understand, they did sell a property, they gained some cash, and paid off most of this debt. So the question becomes, what is 2024 going to look like? And they have roughly $446 million of refinancing costs in 2024, where I do believe it's going to come down to a few different things. Obviously, it's going to come down to cash. They might have to cut their dividend once again. They might have to sell another building, but they definitely are going to have to start figuring out what 2024 debt costs are going to be and how they're going to maneuver around that. Where the big problem lies is where are interest rates going to be in 2025 and 2026. I believe that they could get through the next 2 years. And then the problem is, can they get back payment from Stewart Properties? Can they get back on the right path? And so this is where we really have to sit back and watch for the company. Cash flows back in again to get debt under control and making sure that the interest rate on that debt is serviceable. So there's definitely a lot of problems here with the company. As you can see, not a tremendous amount of cash. You'd probably like to see that cash probably closer to $500-600 million, and then you know that they would be okay. But where the cash is and where the burn rate is right now, and the fact that they do have refinancing debt coming up in 2024 that I think is quite manageable if they're able to liquidate properties or even collect some back payment from Stewart Properties. The problem is going to be, where are interest rates going to be in 2025? Are they going to be able to handle that debt load? And did they get revenues back under control? If everything starts executing within 2024, this one could be a hidden gem, especially if it gets any cheaper. But of course, the market is pricing in some bad things here, and we have to understand that. And I think I unfolded this story to the best of my abilities to exactly why it's priced to where it's at. So let's talk about PFIZER. Now, PFIZER was probably the most important company through the pandemic, and they absolutely cashed in on it, skyrocketing revenues from roughly $60 billion to $100 billion of top line revenue. The company was trading over $50 a share and is now trading at $30 a share. And when I did my price valuations on the company, I got between a $32 to $33 price target, which is the lower end of most experts' valuations on the company. So from a visual standpoint, we can see that COVID absolutely spiked their revenue, gave them those additional earnings per share. That skyrocketed their stock price because price usually does follow earnings. And so now the big debate on PFIZER is, do they have anything in their pipeline that's going to be innovative and create more revenue? Because revenues are dropping off very hard, but I priced that into my price targets here. And so instead of a $40 and $50 stock, I did get closer to a $30 stock. But this is not what I'm upset about. Here is what I'm upset about. Now, I personally believe PFIZER could have issued this type of guidance during their last earnings call, or at least brought up some ideas that this could be the problem, but instead they wait a few weeks before they report earnings and drop it on a Friday after hours where most investors are not paying attention to the market. And what do they drop? They drop their guidance down from $58 to $61 billion of revenue, which now brings their EPS from $1.45 to roughly $1.65 for a full year of 2023. And so my model is now really messed up here because, as you can see, I was actually shooting on the original low end of their revenue expectation for 2023 at $69 billion. And as we stated earlier, they moved that down from $58 to $61 billion and slashing its EPS in half. So two massive headwinds here. Not only is revenue declining, but they are slashing EPS in half. And so now a couple different questions we have to ask ourselves. What multiple is it currently trading at for 2023? And right now the stock's trading roughly $31 a share divided by 1.5. So we're going to say instead of $1.65, they do about $1.50 because right now we definitely want to err on caution with the company. We get a 21 multiple here, which is making the stock extremely expensive. Now, the other things we have to factor in here is the deal for CGen should be closing. They are building out their pipeline. And so those additional aspects of 2024 is really what we have to keep in the back of our mind. What kind of revenue can we expect for 2024? And we really don't have clear guidance on that right now. So here I have it just under $61 billion of top line revenue, which is where they're guiding roughly 58 to 61. So I'm meeting somewhere in the middle here. And then from there, I'm projecting about 5% revenue growth. Now, with the acquisition of CGen and what they have in their pipeline, I really think that they are just kitchen sinking this, because they realize the quarter's going to end bad. They're going to close out 2023 bad, but 2024 and 2025, in my opinion, could be promising when we think about all the types of diet pills that are coming out, diabetes pills, and they definitely have some interesting things in the pipeline, and closing the deal with Seagen is going to leave some opportunities here. So this is a very, very tough one to actually put on. And so still keeping my growth rates fairly conservative here at 5%, 6%, and 4%. Still stating that the next few years are going to be tough. I think they get a tick up in revenue growth in the next 3 to 6 years because of the acquisitions of Seagen and what they have in their pipeline. Eventually, these things should come to fruition and bump up revenue growth. And so when we look on a forward basis, a stock that was really cheap, trading at 9 times earnings, has now doubled because their EPS was slashed in half, trading at 20 times earnings, versus industry standard of roughly 18 times earnings. So now all of a sudden, instead of a cheap stock, we are actually paying for an expensive stock when we look at 2023 into 2024 earnings. When we look at a multiple EV to EBITDA, we see here that industry standard is trading around 13.5 times earnings. And so now all of a sudden my price target has changed on PFIZER, basically going from $32 to $33 a share, now sitting around $25 to $26 a share. And so that is a big difference when we look at what we were projecting versus what reality has happened. And I blame a big part of this on management not being transparent with what they were projecting out. They could have dropped this news a lot sooner, and even though we were still cautious on their revenue guidance, it still blew up in our face because they came in roughly 10 to 15% below our expectations, even though we were undershooting it pretty drastically here. And so, not a huge difference from my original price target, basically a 15-20% difference, but still it's impactful as an investor to understand this. Now, the second part of this problem that becomes a little interesting is actually going to be the payout ratio on the company. Even though it's sitting at 85% right now for the trailing 12 months, it's actually going to be a lot higher than this because their earnings per share is going to be sitting around $1.50 to $1.65, and they're currently paying out $1.64 on dividends. So this is something to monitor here, ladies and gentlemen. I do think we did a good job of pricing in kind of the bad stuff here, getting a fair market value. And we're not far off to where it's trading. The question's going to be, is there more downside risk with the company? Could there be a dividend cut here? Because the acquisition of Seagen could be very expensive with rates where they're at. And so some of the financing for this deal is going to get more expensive. They are making internal cuts, and they're supposedly going to save roughly $3 billion. Anything under $30 definitely becomes interesting on the company. I think 27 is definitely enticing. And I do believe that they will innovate enough to start bringing stuff through on their pipeline to end up generating better top line revenue. So definitely something to follow, but I want to be transparent to where I am with both these companies, and I'm curious to what the outcomes could be for both of these companies. And so this is just my opinion. Of course, it's not financial advice, but appreciate everybody's time. We will see you in the next one.